What do you do if you're a high income wage earner? It's late November, early December, and you've got $1.2 million of W 2 income that you've made at your job this year, and you're looking at a $400,000 tax bill. Is there anything that you can put in place this late in the year to legally reduce your tax liability? And is there a way you can do it where you're not risking money in some crazy oil and gas partnership or allocating funds into an energy tax program that you just don't understand? In today's video, I'll share with you a real life case study of a client who contacted me from California. He's an engineer. He works for Netflix. He's sitting on $1.2 million of income. That's what he made this year in his job. He's in his mid 40s. He has two kids. He's asking the question, Dave, is there anything I can do? I know it's late in the year, but I don't want to pay $400,000 if I don't have to. I will share with you in this video the secrets of how you can properly implement a Section 179 deduction to not only to reduce the tax liability of $400,000, we zeroed it out. We took it down to zero. This man got a refund and he was able to make $1,200 a year for the next 30 years on this idea. Let's take a look on how it works. I'm going to share my screen. We'll see exactly kind of how this happens and how this functions. Here's the title of the slide. His wife is very happy because he came up with a plan to save $400,000 in taxes. This is their 1040 tax return prepared for them. Again, $1.1 million of W-2 income. Not bad. Tax liability, federal, $350,000, state, $50,000, $400,000 in taxes due. That was without tax planning. This is what he had been doing. I mean, this man had a CPA and he was doing a good job on telling him how much he owed in taxes, but he wasn't very forthright or forward thinking on sharing with this man ideas on how he could reduce his tax liability. This is where tax planning comes into play. Now, full disclosure, primarily, we've used our Supercharged Roth conversion tools to help reduce the taxes for individuals that are doing multi-million-dollar Roth conversions. But that's taxed as ordinary income the same way that your W-2 income is. And Section 179 works every bit as well for someone that makes $1 million of W-2 income as it does if you're doing a multi-million-dollar Roth conversion. Again, for this client's own personal circumstances, applying Section 179, when people ask, well, what is it? How does this tax hacks work? Well, Section 179, to be classified as Section 179 property, it's got to be personal property. Is the definition that's used in the active conduct of a trade or business. There's a couple of different definitions in the tax code, but one of the special definitions is that it's tangible personal property that's used to mainly furnish lodging, or it's in the connection with furnishing of lodging to qualify for this exemption. So our recommendation for John, our engineer out of California, is that he start a side hustle. He's going to start a separate LLC business. He's going to be in the business of doing short-term rentals. Him and his wife are going to be joint owners of this business. We're going to set it up so it's Section 179 compliant, and if properly implemented, this will save him $400,000 in taxes and completely eliminate his income of $1.1 million. A key takeaway is this is not a VRBO. He's actually purchasing a tiny home. The tiny home manufacturer has this classified as business equipment because it's primarily being used for the furnishing of lodgings, but it's mobile. So his cost for this, again, it's being financed by the manufacturer. It's a $375,000 purchase price. John puts $100,000 down. He has a loan of $763 a month. It's at a 0% interest rate for the next 30 years. Because the tiny home is classified as a Section 179 deduction, that entire $375,000 is able to offset his income. John decides to be a planner and he buys 3 of these units. Doing so gives him a discount, but he gets the entire amount. The $1.1 million of his income is offset by purchasing 3 of these units. The Section 179 limit for 2024 is $1.2 million. It gets a little bit better. And then again, these are pictures of the actual tiny home, of examples of the tiny home and what they look like. These are high quality, phenomenal high quality units. that are very durable. They stand up to hurricane force winds. They're made out of steel. They have a longer durability life than most stick built homes. John is signing this 30-year lease, or he's signing a 30-year financing agreement with the manufacturing company. Again, 0% for 30 years. On the date of signing, he also signs a third-party subleasing agreement where a third party agrees to lease his tiny home out, and they're going to pay him $865 a month. So if you caught this, John is paying $763 a month, and he's getting income of $865 a month on his tiny home for the next 30 years. It's a non-cancelable lease. The leasee is setting up the insurance. They're transporting the unit. They're furnishing it. They're in charge of any repairs. They have a hold harmless guarantee and indemnity clause that protect John from any damages that his tenants may incur. In addition to that, if his tenants do incur damages, the leasing company is making him whole. So John spends $270,000 to save $400,000 in taxes. The net impact of that, his net savings, is $138,000. What could John do with an extra $138,000? Again, he's in his mid 40s. He works at Netflix. He could redirect those funds into Netflix stock. He gets an employee discount. Who knows what that would be worth in the next 30 years? He could invest in other asset classes if he wanted to. He could start it. He could buy more of these units. The question that John's wife has is, how secure is this leasing company that's signing this lease for you with the next 30 years? Again, it's a non-cancelable lease. They can't cancel it. They're on the hook for the $860. The leasing company is making money renting these units out, sub-renting them out to individuals in the oil and gas fields in Oklahoma and Texas. You've heard the term man camps before. These are pictures of actual man camps. They're not very comfortable for the workers. So the oil companies themselves will also enter these leasing agreements to provide more compelling housing for their tenants. Currently, these folks are sharing bathrooms. It's cramped conditions in quarters. These units, these tiny homes, if oil and gas blows up and we have a repeat of 2018 where oil goes to zero, these are portable units. They're not fixed. They can be picked up and moved and transported. This is the responsibility, again, of the leasing company. The market for these units is exploding nationwide. They're also classified as accessible dwelling units. You've seen what's happening to housing prices across the country. There's a shortage of 40 million single-family homes. Cities and counties across the country are changing their zoning laws that now allow individuals to place these additional units in their backyards to alleviate the housing crunch crisis. So is that a growth opportunity for you above and beyond just the transient housing? What about setting this up in disaster areas with FEMA and so on and so forth? So there's ample opportunities. If John comes across a leasing company that's doing a better job, that pays him more money for his unit, he's under no contract. He can cancel that contract and go with them. What John needs to understand, and I stress this, is that this is not a hobby. This is not an investment. This is a business, and it needs to be treated as such. To be eligible for Section 179, you have to show that you have active participation in the trade or business. Now, it's somewhat different from the requirement of having 100 hours to be a professional real estate investor, to take advanced and accelerated depreciation expenses on real estate property, because there is no line in the sand law that says to be a profitable business or a real business, you have to spend X hours of time on the business. You and I both know that there's business owners who are very profitable, who hire the day-to-day activities of that business out. In John's case, he needs to prove that he's got active participation. So this can include monitoring the lease agreements on a regular basis, having sit-down meetings with the leasing company once a quarter, monitoring the activity that goes on. They have Ring cameras at his unit that he could log on to and monitor. He could even fly down and stay in the unit once a year if he wanted to. It's his business. There's spillover benefits as well. Once he has the LLC established, again, he's making $1,200 a year. He could use the Augusta rule and rent his own personal home out for business meetings, so he's not taxable on that income. He could redirect it into his kids. They could have they could set up tax-free Roth IRAs. He's not limited to doing this It's not a one-time thing. So John's making $1 million every year, then he buys 3 units every year to offset that income. There is a time sensitive nature here. There's only a finite amount of these transient housing opportunities available. Again, to be Section 179 compliant, this is what makes the tiny home unique and eligible for this deduction, whereas a regular house doesn't. It's portable. The lodging that's being provided is for transient workers, 30 days or less. Once those slots are filled up, the opportunity isn't as lucrative. So not only do you have time where you could still do this before the end of the year, it takes about 3 days to set up an LLC. You have to ask yourself, what are the consequences if you don't do this? Well, in John's case, the most obvious is fairly simple. It's $400,000 in taxes that he'd have to pay. Does he want to do that or not? Could John manage that $400,000 more efficiently than the government would? Because that's really the alternative. John's giving his money to the government, but he doesn't have to. He could take possession of that $400,000, start a business, and then start being more of a producer with this country. He could be employing people and jobs and creating things. John could do a better job with the $400,000 than the government can. The $138,000 in savings, that's just the year one savings. That, again, invested, what could that turn into? Who knows? $1, $2, $3 million. This could be the start of something epic for John and his family. This Section 179 deduction, if properly employed, can reduce ordinary income. It can reduce Roth conversion income. It's just one of the tools that I teach in the Supercharged Roth conversion process. We routinely do multi-million-dollar lump sum Roth conversions and stay in the 10% tax bracket. Again, there's tax preparers and there's tax planners. We want to understand all the dynamics of the code that apply to ordinary income that John can offset as a W-2 earner and that you can use if you have multi-million-dollar IRA accounts. If you like the information that we've provided here, then please click on the link, subscribe, and share this. Share this with your coworkers. If you have other coworkers, birds of a feather flock together that also make $1 million, send them the link. Click on the link, get on my calendar, speak to a member of my staff. We're happy to walk you through the timeline of what's involved in getting this set up, review the pitfalls again with you as well and the benefits. Thanks for watching to the channel. Don't forget to like and subscribe. Thank you.